Vikalp Ltd provides you the following information for the year ending 31st March 2019. Earnings before interest and taxes 28 lakh 80,000 and interest on long-term loans at 12% is 2 lakh 70,000. This 2 lakh 70,000 is the interest that we are paying on long-term loans. But what is the amount of loan that we actually borrow? So that is something which we need to calculate. Interest on debentures at 10% is 3 lakh 60,000 and these debentures were issued on 1st August 2018. So again, this 3 lakh 60,000 is the amount of interest that we are paying on debentures. What is the total value of the debenture that we issued? That is something which we need to calculate. And most importantly, this interest is the amount, this 3 lakh 60,000 is the amount of interest that we paid for a period of 8 months because the debentures were issued on 1st of August 2018. So August, September, October, November, December, January, February, and March. So this is the interest for 8 months period, not for the 12 months period. Earnings before taxes 22 lakh 50,000. This is nothing but from EBIT we are subtracting the interest expenses. We will get earnings before tax, and the tax rate is 30%. So when we apply 30% on earnings before tax, we will get tax expense of 6 lakh 75,000 and earnings after taxes 15 lakh 75,000. Number of outstanding equity shares is 6 lakh 30,000 and the current market price is rupees 24 per share. Undistributed reserves and surpluses 60 lakh 50,000. This is nothing but the amount of retained earnings. The company needs to raise 3 million for modernization of its plants and has the following options of raising the funds. So the company needs 3 million for financing the modernization of its plants. And the company has two options for raising this 3 million. The first option is the company can raise this entire 3 million rupees in the form of a long-term loan, right? And the company can borrow this 3 million at 13% interest. This is one option. And the second option is raise partly by issue of equity shares at rupees 20 per share. So what they are saying is the company needs 3 million, which is nothing but 30 lakhs. Out of the 30 lakhs, the company can raise 15 lakhs by issue of equity shares. How 15 lakhs? Because the company is going to issue 75 equity shares at rupees 20 per share. So 75 into 20, we get 15 lakhs. So 15 lakhs can be raised in the form of equity shares and the balance by 11% debentures. So the balance 15 lakh can be raised by 11% debenture. So here 50% equity and 50% debt. The company expects the rate of return on funds employed to be improved by 3% because of modernization, and if that debt if debt equity ratio exceeds 45%, then price earnings ratio will go down by 15%. So what they are saying is the company is going to modernize its plans, right? Because of that, the return on capital employed of the company will increase by 3%. From the existing return on capital employed, the return on capital employed of the company will increase by 3% because of the modernization, and the company is going to raise 3 million rupees of additional capital, right? Due to this, the debt equity ratio of the company will change. If the debt equity ratio is greater than 45%, in that case, the price to earnings ratio will come down by 15%. So in this question, the price to earnings ratio is not directly given. So that is something which we need to calculate. We will do that once we start with the question. And the requirement of the question is if the company is to follow policy of maximizing market value of equity share, which option should it choose? So here the company has two options for raising the additional capital of 3 million rupees. The company can go for 100% debt, or they can go for 50% equity and 50% debt. So if the objective of the company is to maximize its market price per share, then which option the company should choose? So that is what we need to decide. So what we are supposed to do is we are supposed to calculate the market price of the share under market price per share under both the options, and we will choose that option which gives us the highest market price per share. So let's start with the question. Let's start with the first working note. Working note number 1, calculation of capital employed. Now, why we are calculating capital employed? Because we need to calculate the return on capital employed, right? So first working note is capital employed. So how do we calculate capital employed? Capital employed is nothing but debt plus equity, right? Because the company can raise funds in the form of either in the form of debt or in the form of equity. So here, what is the amount of existing debt or what is the amount of existing borrowings that the company has made? So here, the company is paying 12% interest on long-term loan and the amount of interest is 2,70,000. So here it can be written as we don't know the amount of loan. So I will write it as value of the loan into the company is paying 12% interest on the value of the loan and that 12 on that interest amounts to 2,70,000. So in that case, what will be the value of the loan? So it is 2,70,000 divided by 0.12. So value of the long-term loan will be 2,70,000 divided by 0.12. We get 22,50,000. So 22,50,000 is the amount of money that the company has borrowed from the bank as a long-term loan. Similarly, the company is also paying interest on debentures at 10%, which is 3,60,000, right? So let's calculate the value of debenture. So I don't know the value of debenture, so we'll keep it as VD multiplied by 10% is equal to 3,60,000. But what is important to note here is this 3,60,000 is the amount of interest that is paid for an 8-month period and not for a 12-month period. So it needs to be multiplied by 8 by 12. So what will be the value of the debenture in this case? Value of the debenture is equal to 3,60,000 into 12 by 8 into 100 by 10. How 100 by 10? Because here it is 10%, no? So when we are taking it to the other side, we have to take the reciprocal. So it is 100 by 10. So what will be the value of the debenture? So 3,60,000 into 12 by 8 divided by, into 100 divided by 10, we get 54 lakhs. So the value of the debenture is 54 lakhs. And then we also have equity share capital. So what is the, but before that, let's write the total debt. Total debt is equal to, the company has borrowed 22,50,000 in the form of bank loan and they have borrowed 54 lakh in the form of debentures. So the total debt is 54 lakh plus 22,50,000, we get 76 lakh 50,000. This is the total amount of borrowings made by the company. Now we have equity share capital in the company. The company has 6,30,000 equity shares outstanding and the value of each share is rupees 10, right? So what is the total equity share capital? Equity share capital is equal to, so basically we have 6,30,000 shares outstanding and the value of one share is 10. So it is 63 lakh is the equity share capital. And we also have a retained earnings of 60 lakh 50,000. So retained earnings is also a part of equity, right? So we have to add that as well. So retained earnings is 60 lakh 50,000. It is equal to 60 lakh 50,000. So here the total equity capital is equal to, or total equity of the company is equal to 63 lakh plus 60 lakh 50,000. We get 1 crore 23 lakh 50,000. So it is 1 crore 23 lakh 50,000. So now the total capital employed will be equal to total capital employed is equal to, we have an equity capital of 1 crore 23 lakh 50,000 plus 76 lakh 50,000. So when we add these two things, we will get 2 crore, or for the sake of simplicity, let me write it as 20 million or 2 crore it is. Right. So the total capital employed by the company is 20 million or 2 crore rupees. Now let's calculate the return on capital employed. That is the working note number 2. Working note number 2, return on capital employed. So return on capital employed is equal to the formula for calculating return on capital employed is EBIT divided by the total capital employed. So ROCE, or return on capital employed, is equal to EBIT divided by capital employed. So return on capital employed is equal to, so what is the EBIT of the company? The existing EBIT of the company is 28 lakh 80,000 and the total capital employed by the company is 2 crores or 20 million. So it is 28 lakh 80,000 divided by 20 million or 2 crores. So what we can do is the numerator can be written as 2.88 million so that we don't need to write too many zeros. So this numerator is nothing but we have 28 lakh 80,000. No, that is nothing but 2.88 million and the denominator is 20 million, which is nothing but 2 crores. So the return on capital employed will be 2.88 divided by 20. We get 14.4%. So this is the existing return on capital employed. But in the question, it is mentioned that since the company is going to modernize its plant, the return on capital employed of the company will increase by how many percentage? 3%. It is mentioned in the question. In the question, it is mentioned that the company expects to improve the rate of return on funds employed to be improved by 3% because of modernization. So what will be the new return on capital employed? So working note number 3, new ROC, new return on capital employed is equal to existing return on capital employed is 14.4%. In addition to that, it is going to increase by 3%. So new return on capital employed will be 17.4%. So this is the new return on capital employed. Now we have the new return on capital employed. With this, we can calculate the new EBIT. See, when I say new EBIT, since the company is employing an additional capital of 3 million in the business, the EBIT of the company should increase, right? Due to the modernization of the plants, EBIT of the company is going to increase. And that is one of the reasons why return on capital employed is also increasing, right? So let's calculate the new EBIT. Working note number 4, new EBIT. So how can we calculate the new EBIT? We know that the new return on capital employed is equal to, new return on capital employed is equal to new EBIT divided by new capital employed. So what is the new return on capital employed? It is 17.4%. So the new EBIT is something which we don't know. What is the new capital employed? The company already has an existing capital employed of 20 million. On top of that, we are going to employ an additional capital of 3 million rupees. So the new capital employed will be 23 million. So new EBIT is equal to 17.4% of 23 million. So 23 million into 17.4 by 100, we get it is 40 lakh 2,000. 40 lakh 2,000 is the new EBIT of the company. Now in the question, it is also mentioned that if the debt to equity ratio is greater than 45%, then the price to earnings ratio will go down by 15%, right? So first we have to calculate two things here. We don't know the debt to equity ratio because of employing an additional capital of 3 million. We don't know what kind of impact it is going to leave on the debt to equity ratio under option 1 and option 2. So first what we need to do is we are going to calculate the debt to equity ratio under both the options, and if the debt to equity ratio is greater than 40%, then the price to earnings ratio has to come down by 15%. You will understand it better once we solve the working notes. So working note number 5, let's calculate the debt to equity ratio. Working note number 5. debt by debt plus equity ratio. We have to calculate it under both the options, option 1 and option 2. So under option 1, what will be the debt equity ratio? So here already we have an existing debt of how many rupees we are having an existing. Okay, but first before that, under option 1, what we are doing? Under option 1, we are going to raise this 3 million rupees of capital by borrowing money from the bank. We are going to take a long-term loan for financing this 3 million. So this total 3 million is the debt capital under option 1, right? And here, before raising this 3 million rupees of additional debt, we have an existing debt of how many rupees? We have an existing debt of 76 lakh 50,000. On top of this 76 lakh 50,000, we are going to raise an additional capital of another 30 lakhs or 3 million, right? So what will be the total debt under option 1? Under option 1, the amount of debt will be 76 lakh 50,000 plus we are going to raise capital of another 3 million or 30 lakhs, right? This is the total amount of debt divided by, we have to take debt plus equity, right? See, since the denominator is debt plus equity, this is nothing but the total amount of capital employed. So what is the total capital employed, new capital employed? It is 23 million or 23 million or 2 crores 30 lakhs. So it is 2 crore 30 lakhs. Now what is the debt to equity ratio? So it is 76 lakh 50,000 existing debt plus 30 lakh of new debt divided by the total capital employed of 2 crore 30 lakhs. So the debt to equity ratio is 46.3% under option 1. See, to put it very simple, the total capital employed is 2 crore 30 lakhs, right? Out of this 2 crore 30 lakhs, 1 crore 65,000 is coming in the form of debt, which is nothing but 76 lakh plus 30 lakh. And the remaining amount is coming in the form of equity, right? So the proportion of debt in the total capital structure is 46.3%. Is this 46.3% is greater than 45%? So under option 1, what will happen? The PE ratio will reduce from its the P ratio will reduce by 15%. What is the from the existing PE ratio? It will reduce by 15%, right? Now let's calculate the debt to equity ratio under option 2. Option 2, what is the debt to equity ratio? So under option 2, what we are doing is we are raising 15 lakh in the form of debt and another 15 lakh in the form of equity shares. So what is the existing amount of debt? Existing amount of debt is 76 lakh 50,000. On top of that, we are raising an additional debt capital of 15 lakhs. So the new debt under option 2 will be 76 lakh 50,000 is the existing amount of debt. On top of that, we are raising an additional debt of 15 lakh rupees divided by the denominator is debt plus equity, no? So it is nothing but the total capital employed, which is 2 crore 30 lakhs or 23 million. So what is the debt to equity ratio under option 2? 76 lakh 50,000 existing debt plus additional debt capital of 15 lakh divided by 2 crore 30 lakhs. We get 39.7%. So the debt to equity ratio under option 2 is 39.7%, which is less than 45%. So now under option 2, the existing PE ratio will remain the same. It will not change. But under option 1, the existing PE ratio from the existing PE ratio, it will come down to 15% because the debt to equity ratio is greater than 45%. Now let's calculate the PE ratio under both. Let's calculate the PE ratio. Working note number 6, PE ratio. The formula for PE ratio is MPS divided by EPS. So what is the market price per share given in the question? I think it is 24 if I'm not wrong. Market price per share is rupees 24 per share. It is directly given. So market price per share is 24 divided by what is the EPS? EPS is not directly given in the question, but still we can calculate it This is a simple calculation. Earnings after tax is given, which is 15,75,000. 15,75,000 is the earnings after tax, and the number of outstanding equity shares is 6,30,000. So 15,75,000 divided by 6,30,000, we get 2.5. So EPS is 2.5 per share. So MPS is 24 and DPS is 2.5. So 24 divided by 2.5, we get an EPS of, we get a P ratio of 9.6 times. So this is the existing P ratio. So let me write it. Working note number 6 is nothing but P ratio existing. Let's calculate P ratio under both the options. Working note number 7, P ratio under option 1 and 2. Under option 1 and 2. So under option 1, what will be the P ratio? So under option 1, the entire 3 million is raised in the form of debt. So due to that, what is the change in the debt equity ratio? The debt equity ratio under option 1 is 46.3%, which is greater than 45%. So from the existing P ratio, the P ratio will decrease by 15%. That is what given in the question. If the debt equity ratio exceeds 45%, then price earnings ratio will go down by 15%. So existing P ratio is 9.6 times. From that, it will go down by 15%. So it is 9.6 is the existing P ratio. From that, it is going to reduce by 15%, means we can multiply it by 85 by 100. So it is 9.6 into 0.85. We get 8.16 times. And to those who did not understand why we are multiplying it with 85 by 100, let me do it using an alternate method. So 9.6 is the existing P ratio. From this, it is going to reduce by 15%. No, so what is 15% of 9 point, not 9.16, it is 9.6, sorry. So existing P ratio is 9.6. From this, it is going to reduce by 15%. So 9.6 into 15%, how much do we get? It is 1.44, right? So what is from 9.6, if you are subtracting 1.44, we will get 8.16. So instead of doing like this, I just multiplied it by 85 by 100. Still, we will get the same answer. So 8.16 is the P ratio under option 1. But under option 2, what will be the P ratio? It will remain the same. It will still remain at 9.6 times itself. Why? Because under option 2, the debt equity ratio is only 39.7%, which is less than 45%. So P ratio will not change under option 2. So now we are done with the working notes. So let's start with the income statement. Income statement starting from EBIT. So we have to prepare the income statement under both the options, option 1 and option 2. First, EBIT. What is the new EBIT? It is 40 lakh 2,000. That is what we calculated in working note number 3 or 4. New EBIT is 40 lakh 2,000. We calculated it from working note number 4. So new EBIT is 40 lakh 2,000. So this is coming from working note 4, 40 lakh 2,000. From EBIT, what we have to subtract? We have to subtract the amount of interest. So here, what is the interest under option 1 and what is the interest under option 2? So listen, currently the company is paying an interest of 2,70,000. So this 2,70,000 can be taken under both the options. So currently the company is paying an interest of 3,60,000. But please remember, this 3,60,000 is the interest paid for 8 months period. Right? During the year 2018-19, we will pay the interest for 8 months. But in the subsequent years, we have to pay the interest for full 12 months. Right? So here, what is the total value of the debenture? The total value of the debenture is 54 lakh. Right? We issued debentures worth of 54 lakh, on which we have to pay 10% interest. Right? So what is 10% of 54 lakh? It is 5,40,000. So here the company will pay 2,70,000 interest on long-term loans, and 5,40,000 interest on debentures. And under option 1, the company has raised an additional capital of how many rupees? 3 million rupees in the form of 13% long-term loan. So the company has to pay 13% interest on this 3 million also. So what is 13% of 3 million? We get 3,90,000. So this is the total amount of interest that the company has to pay under option 1. So under option 1, the interest expenses will be 5,40,000 is the amount of interest paid on debentures, plus 2,70,000 is the interest paid on existing long-term loan, plus 3,90,000 is the interest paid on the new long-term loan borrowed. So what is the total amount of interest? 5,40,000 plus 2,70,000 plus 3,90,000, we get 12 lakhs. So 12 lakh is the total amount of interest that the company has to pay under option 1. Now similarly, let's calculate the total amount of interest that the company has to pay under option 2. Under option 2, the first two amounts will remain the same as option 1. 2,70,000 and 5,40,000 will remain the same. Why? Because these are the amount of interest that the company is paying on existing debt. So these two amounts will not change. Under option 2, what the company is doing? The company is raising 15 lakh in the form of equity share capital, remaining 15 lakh in the form of debt. So here, under option 2, the company is raising only and the company is raising an additional capital of only 50 lakh in the form of debt, right? So here, this 15 lakh is option 2. Yes, this 15 lakh is raised in the form of 11% debentures. So 15 lakh into 11%, how much do we get? We get 1 lakh 65,000. So under option 2, the company will pay 2,70,000 interest on existing long-term loan, 5,40,000 interest on existing debentures, and 1,65,000 interest on the additional amount of borrowings or additional amount of long-term loan. So interest under option 2 will be 2,70,000 on existing loan plus 5,40,000 on existing debentures plus 1,65,000 on the new borrowings made by the company. So 9,75,000 is the amount of interest under option 2. So from EBIT, subtract the interest. What is the amount of EBT that we will get? 40 lakh 2,000 minus 12 lakh. So yeah, we get 28 lakh 2,000. So this is 28 lakh 2,000 is the EBT under option 1. Under option 2, the EBT will be 40 lakh 2,000 minus 9,75,000. We get 30 lakh 27,000. So this is the amount of EBT under option 2. From this, let's subtract the tax. So the applicable tax rate is 30%, which is given in the question. So tax rate, so when we take 30% of 28 lakh 2,000, we get 8 lakh 40,600. And when we take 30% of 30 lakh 27,000, we get 9 lakh 8,100. So what is the earnings after tax under both the options? Earnings after tax under option 1 is 19 lakh 61,400 under option 1, and under option 2 it is 21 lakh 18,900. 21 lakh 18,900 is the amount of earnings after tax under both the options. Now let's divide this earnings after tax with the number of outstanding shares. So the number of outstanding shares under option 1 is going to be the same. Why? Because under option 1, what we did, we raised the additional capital of 3 million in the form of bank loan, 100% debt. There is no issue of additional equity shares under option 1. So it is 6 lakh 30,000 itself. But under option 2, what we did, we raised 50% of debt and remaining 50% by issuing 75,000 additional equity shares. So what is the existing equity shares? It is 6 lakh. Sorry, the existing equity shares is 6,30,000. On top of that, we issued additional 75,000 equity shares for additional 75,000 equity shares under option 2. So the total equity shares under option 2 will be 6,30,000 plus 75,000. We get 7,05,000. So the number of outstanding shares under second option is 7,05,000. So what will be the EPS under both the options? EPS under option 1 is 19,61,400 divided by 6,30,000. We get rupees 3.1133 per share. This is the EPS under option 1. And EPS under option 2 will be 21,18,900 divided by 7,05,000. We get an EPS of 3.005 per share. So it is 3.005 per share under option 2. So now we are supposed to calculate the market price per share. Why? Because in the question it is mentioned that the objective of the company is to choose that option which maximizes the market value of equity shares. Now we have the EPS. How can we calculate the market price per share? We have already calculated the PE ratio under both the options. Under option 1, P ratio is 8.16 times. Under option 2, P ratio is 9.6 times. So when we multiply EPS with PE ratio, we will get the market price per share. Why? Because listen, what is PE ratio basically? What is the formula for PE ratio? It is MPS by EPS, right? This is nothing but the P ratio. When you multiply P ratio with EPS, what will happen? EPS gets cancelled out and you are left with MPS. So when we multiply P ratio with EPS, we will get the market price per share. What is the P ratio under option 1? It is 8.16 times, which is coming from working note number 7. Working note number 7. And what is the P ratio under option 2? It is 9.6 times, which is coming from working note number 7. So when we multiply P ratio with EPS, we will get the market price per share. So it is 3.113 into 8.16. We get a market price of 25.40 per share under option 1. Market price per share under option 1 is 25.40 under option 1. And under option 2, it is 3.005 into 9.6. We get a market price of 28.85 per share. 28.85 per share. So this is the market price under option 2. So if since the objective of the company is to maximize the market value of equity shares, the company should go with option 2 because market price per share under option 2 is greater than the market price per share under option 1. So the company should go for option 2.